purchasing power parity. And if we think in terms of price levels and goods, well, first it's easy to think about first understanding why might or might not hold in terms of the individual good. Let's see if we can figure out the exchange rate. Between Germany, Europe, and Vietnam. We'll just pretend, I hope these are reasonable. We have ounce, we want gram. So purchasing power parity tells us that, well, it's about arbitrage. The exchange rate has to be such that if the price of gold in Frankfurt in terms of dong is different than the price of gold in Ho Chi Minh City in terms of dong, then we could buy gold in one place and sell it in the other place and make a profit. So let's see if it works by looking at two different examples. In Frankfurt am Main in Germany, 99.82 euros per gram gold. And I have a gram of gold. Not sure where this is. It's somewhere in Vietnam. So let's talk about city. 310. 310. 508. Cool. So I'm writing the units there. It's very important because if we take this price, BND per grams gold, and divide it through by the price we have for gold in Frankfurt, we should notice that gram gold cancels, and so we have an expression in terms of units that's BND per euro. So if we do this calculation, we get get an exchange rate in Vietnamese dong per euro of 31,106, which is about right. Yeah, this seems to make sense. Okay. Let's try a different good. So we're, if we can just leave with Ho Chi Minh City, we're technically in Ho Chi Minh City, right? And I paid 45,000 dong for lunch. But how are we going to compare this, right? Lunch in Germany is different, right? It's not the same thing. What did we have for lunch? What's that called? Was that? Is that full? What was it called?
You mean?
Yeah, but we had just had for lunch then.
Beef noodle.
The beef noodle. Let's see if we can find something similar. At a Vietnamese restaurant in Frankfurt. So here they have their lunch menu. We see something similar. M7? Yeah. Okay. So for the lunch dish, that's 12 euros. So we'll go with the 12 euros. Right, so now we're comparing, right, even a similar dish. 12 euros for lunch. So I need to now divide, and if I divide them through, right, the same thing's going to happen before. I'm going to be in D per euro, the units, and I get 45,000 divided by 12, which is 3,750. That's a lot different number, right? The exchange rate's wrong. What does this mean? We can make a profit, right? If we just get we get our Bun Nam Bao, right? And fly to Frankfurt and sell. Right? It's the Cafe Su example. This is hard to trade, hard to transport. We can't really. The arbitrage example fails. Right? Yeah. So we see that it makes sense that this isn't gonna work out, right? But it works out for a homogeneous transportable commodity like gold a lot more quickly. So what this just means, if you do an exchange and you come to Frankfurt and you want to eat food from back home, it's going to be very, very expensive, right, relative to the prices that you're used to, right? If we take it the other way around, right, the dong price, we do 31,000 times 12 euros, that's right, 372,000 dong, right? Is what you pay for right? Big difference, right? So we already know why absolute purchasing power parity can't hold for an entire economy between the price levels of the entire economy, because it might hold for some goods, right? And it certainly seems to, but it doesn't for other goods, and we know why. Yeah? Another example, in Frankfurt, a haircut cost me, speaking of my fantastic hair, about 30 euros, right? Which is then going to be almost $1 million dong. Right? A haircut is probably a lot less expensive for me in Ho Chi Minh City, right? So all we need to do to make money, let's pack up haircuts on a plane into services are an example. It's impossible. Those are definitely non-tradable. lunch is difficult to trade. A service is impossible to trade. So that's why we said, okay, so maybe it doesn't hold in absolute terms, but in relative terms. So if things in the domestic price are getting more expensive, right, so if things in Vietnam are costing more dong, then we would expect the exchange rate to go down, right, in terms of the amount of euros that we can get per dong. Right, so there's going to be some reasons why this doesn't hold on a level, on an absolute level, but if prices in Vietnam double, so what's the increase by, let's just do it by double. So if the gold price goes to 6 million VND, then we expect the exchange rate maybe in absolute terms of gold to go up to 62,000. Right, the price of lunch doubles to 90,000. Right, this is still going to be the wrong exchange rate, but if we think about if all the prices in Vietnam doubled, then it's probably very likely that also the exchange rate is going to double as well, right? Because what holds true for gold is now holding for everything else. Yeah? So this relative purchasing power parity is going to capture, or is going to just say, look, there's going to be some, because of non-tradables, a level effects between countries that can't be arbitraged away. Now we can compare the example with exchange rates. So I went through an example. Covered interest rate parity is what we could do if we have arbitrage with different interest rates, if we have access to a forward market. So we use the exchange rate instead of the exchange rate that's we expect to hold in a year. We can go to a market and ask what the price is for delivery of the currency we're interested in a year. And the forward market is extremely important. It's not just for speculation, for investors here trying to make money. Imagine you're an airline, Vietnam Airlines. You know? So you have costs in dong, right? Personnel costs. You also have to buy fuel, which costs, you have to pay in dollars. Dollars, gasoline, oil is the currency for oil is dollars. But then you have maybe customers, right, like me, who paid in euro. So the Vietnam Airlines has to deal with all of these different currencies, right? Well, we have our plan. We know our planes are going to be flying back and forth between Vietnam and Germany. I know, right? I'm going to have some euro income. I'm going to have some dollar expenses and some dong expenses. I can now buy. But so I buy a ticket in euros. They go to the Vietnam Airlines, takes my euros. They can convert that right to dong. My flight isn't going to take place for 6 months, but that's okay. They can buy delivery of dollars in 6 months today in dong, so that they can use the dollars to buy the oil that they need in 6 months. And there's no more currency risk. They've completed all the transactions today. We go to the futures market, get delivery of oil or airplane gas in 6 months. After getting dollars in 6 months, that's fine. I can buy delivery of dollars in 6 months with dong today, right? And so we can use forwards in this speculation or speculative markets to remove all the risk. And once we brought it all to transactions that are covered today, then it's an arbitrage condition. So we know that the foreign exchange rate has to satisfy this equation. If it doesn't, right, then you can make a profit by buying or selling bonds between two countries, exchanging the money, and buying or selling forward contracts. And then this money is no risk. It's all settled at the end of the day. Right? So, you know, I mean, imagine, right, the reason why, again, arbitrage works, right? Imagine I gave you a device where you push a button and it gives you 1,000 dong. You just get 1,000 dong. I would start and push it as fast as I can, right? Let's get it, you know? And that's what people are going to arbitrage. There's no risk. Just do it as much, and that's why it works, because there's an immediate, enormous pressure on prices. Yeah? Uncovered interest rate parity, that's what we use in the Mundell-Fleming model, in open economy ISLM. We had the expected exchange rate. Well, this can turn out to be to hold or to not hold. It can be higher or lower, less than or greater than, right? After the fact, because the actual exchange rate might turn out to be different than what we expected. And then there's also an interesting, difficult question. What is the expectation of the exchange rate? What do you expect the exchange rate with the euro to be in a year? Is it maybe different than what I expect? Maybe different than she expects? Oh yeah, there's no such thing as this one expectation. We have different expectations for a number of different reasons. We might have different information, right? There might be, you know, different behavioral reasons, right? Or different, we might have different models or different ways of producing forecasts. So there's going to be, right, likely a collection of expectations, right? So, but if you're going to be, so this is going to tell you why we're going to have some people buying Vietnamese bonds and selling Bhutanese bonds, and other people doing the exact opposite of the transaction. If my expectation for the exchange rate is higher than your expectation for the exchange rate, right? We both can be doing the opposite ends of the transaction, and in expectation, we're both going to make a profit. Right? But we'll just have to see at the end who wins. Yeah? Who's right, who wins. All right, so there's an investment strategy between countries that's always comes up in the news. When you see large interest rate changes, it's called the carry trade. And the idea here is to borrow money in a low interest rate currency and invest in a high interest rate currency, and then you're going to profit from this interest rate differential. Now, the uncovered interest rate parity suggests, right, that this the currency with the higher interest rate should depreciate in value so that after maturity there's no gains. Right? But if the interest rate parity doesn't hold, then carry trades can be profitable. Right? But the thing to keep in mind is if you look at the newspapers or reading an article or talking to friends, if they say, look, interest rates in Indonesia are up to 15%. Right? And interest rates here in Vietnam are only, or interest rates 5%? Or 5% was right? Okay. So that's 10% more in Indonesia. Let's all invest in Indonesia. Right? We're going to make more money. Well, wait a second. It depends on what happens with the exchange rate. And we don't know exactly where it's going. So there's risk involved there. Okay. Right, and the idea is if many investors engage in this carry trade, it can lead to an appreciation of the high interest rate currency. Everyone's going to try to buy Indonesian bonds, right, driving up the value of Indonesian currency and lowering the but it's risky. You can have sudden reversals in exchange rates, unexpected changes. So there's no reason to assume that this is going to carry through. All right, so what does this have to do with efficiency of financial markets? The neoclassical theory says that all available information is reflected in market prices. If a complete market system is in equilibrium, it must be efficient. The Arrow de Bruyne from the 1960s 50s, looking at the economy was contingent claims. Right? The idea is if we could have a set of financial instruments that pay out contingent on any event, right? I came up with a contingent claim. It paid me a meal if I was hungry and nothing otherwise, or paid me a meal if I wasn't hungry. It's contingent on whether I was hungry. So you could think about, a world if we have perfect markets. What that means is we're going to have an asset for every possibility, every possible contingency. Which means there's a market now that has a contingency of every possible combination of grades that you could get on my exam. And people are trading these assets. We can talk about this in theory, and that might be interesting, but I don't think then that we have complete markets. We're missing those securities, right? It's a question how important that is for the markets, but nonetheless. Private information is going to influence market prices. This is also, right, this is the whole point. If I know something that you don't know, and I go to the market, I know that Bitcoin is going to go up. So I go and I buy Bitcoin, and this pushes the price up. I've already, by engaging in this purchase, by following my private information, I reveal my private information, perhaps. And this is what drives the idea of efficiency of financial markets. If I know something that you don't know and I act upon it, then my acting upon it is going to affect prices, i.e. the prices are going to incorporate and reflect this information. All right, so this is the idea of all available information is reflected in prices. Right, so you can't, there's no way to earn an abnormal return based on information. The information is already there. Right, but so what information, how can we do this? We have, how efficient is the market? Does it at least incorporate everything from the past? Right? Do we have efficiency in that everything is publicly known? Right? Is there going to be incorporated into prices? Or do we have really this very strong form of efficiency that we have all public and all private information that's working the prices? Right, so this revelation of private information. If we look in 1979, we have a good example. Right? We just came with an example for why this cannot hold. Right? Mathematically, Radman showed that one of the conditions, that's a necessary condition, is that there is a number of independent securities that's greater than the dimensions of, say, the dimensions of the possible contingencies. All right, so we just think about the contingencies that we can have of grade, just of your grades. Everyone else has grades. And all that combination, and the grades of all just if we looked at every individual student alive right now, counted them up, and all the possibilities of different grades they have, those are all different states of the world. And we're very quickly going to run out of independent securities. There are lots of different bonds and stocks and things like that traded, but just counting the number of possible combinations of things that could happen, not just grades that students could have, but things that could happen, right? Is quickly going to exceed the number of independent securities. Right? So if our signal space, the different places where we get information is large, which it of course certainly is, then it's probably going to be difficult for us to reveal this private information. And the whole point is that if I buy a U.S. bond, does this mean that I have some private information that the central bank is going to lower interest rates in the future, and I'm trying to lock in the higher interest rates? Does this mean I have private information about the solvency of America? Does this mean I have private information about Donald Trump's health? Does this you can think of a million different reasons for why I might buy a US bond, right? Which one is it? We can't really reveal this. We can't disentangle this possibility, all these different possibilities. So this means it's really difficult for us to claim that markets are then able to incorporate all private information. Now, the semi-strong form that at least all public information is incorporated. If it's something that's out there that's public, right? As soon as Google makes an announcement of its quarterly profits, that was reflected in its stock price. You know? Public information, right, was confirmed back in the 1970s by Eugene Fama, for example. Right, but some authors, like Leroy, have found empirical evidence against even the semi-strong form, right? It even argues that this weak form efficiency is mixed, right? We don't even incorporate perhaps all past information of our information sets. Right, so these are just some older studies that even then showed that it's not clear that financial markets are always efficient. So the idea here is that if prices reflect available information, then any trading strategy that's also based on the same information must yield an expected profit of 0. And since it's our trading, buying and selling, that's moving prices, then prices must follow a random walk with a drift that corresponds to the market rate of interest. So we have some growth in the economy that generates or is associated with a market return, and the price of any individual asset, individual stock, is going to roughly follow this market rate, but with a random walk. Right? It's also called the drunkard's walk, right? So they should just be, wandering around unpredictably. If you Google, there's a very classical book about stock markets called A Random Walk Down Wall Street. That's what we look at here. And that's the consequence, that's the prediction, right, that we can now test with data. So this would be the statistical model from lecture 00 that Thomas Sargent was talking about, that we can now confront with data. So there's evidence that stock prices and commodity future prices do indeed follow a random walk. However, there exist strategies, right, that yield higher returns than buy and hold. So there are abnormal returns. And there's also an autocorrelation that shouldn't be there in terms of random walk. When there's one large price change, another large price change that follows, either positive or negative direction, is more likely. Right? So we see an autocorrelation in volatility. So if there's a big step in markets or in one stock price, there's likely to be another big step afterwards, be it positive or negative. Right? And this is a little questionable. Right? So this not something with over or under reaction. And furthermore, it usually tends to be the price reversals are more likely. So there's a big step in one direction, the next day there's more than likely going to be a large step in the opposite direction, right? A correction. Maybe the arguments here put forward that this is due to private information. That we have the way markets are done, the order book, the way that bids and sales are processed is private information, right, that's in the books of the market maker. So if you buy and sell stocks, you're just going to go to a broker, these large brokerage houses. They assemble lots of different orders of people wanting to buy stocks at different prices, and they're the ones who reconcile these. And a lot of the way the orders in which they do this, right, is contained inside this order book. It's private information. We don't see, right? We don't see the transactions, the orders that I've posed. We only see the orders that are actually processed. Right? I can post an order saying I'm willing to buy 1 share of Apple at €1. Right? And if that doesn't clear the market, which it won't, right, then you likely might never see that I posted the order of 1 share of Apple for €1. Right? Right, but we can find some funds do not outperform the market portfolio average. So fund managers don't do better than the market. That was the lesson there, which would point to efficiency of financial markets. So some studies, this is also the question, have shown that certain studies would have been successful in the past. This is not a sign of market inefficiency. Right? After the fact, my strategy of buying Bitcoin in 2012 would have been successful, right? But I didn't know in 2012, trust me, I didn't know in 2012 that Bitcoin was going to increase in value by so much. If I would have known that, I would have behaved differently. So pointing out after the fact that there are things you could have done in the past doesn't mean that the market somehow failed. Right? Just this information wasn't available there. Okay, so we want to pricing a stock. We have if we do this in terms of no arbitrage, or risk neutrality. The price of the stock is equal to the expected dividend plus resale price, discounted. We can be discounting this with beta, or we can discount it with 1 over 1 plus R, the market return. Which is the relation between these two we saw in our consumption savings model. Or we can rearrange this and get the expected return of a stock. Right? The return is the sale price plus the dividend we earn minus the purchase price relative to the purchase price. This gives me the per share return. And if that's not equal to the market return, then we have a speculation possibility here. We can also rearrange this by solving this equation forward to get the price of a stock as the sum of the expected present value of the stream of dividends and a bubble term. All right, so if we just take this equation here, lag it forward 1 period, and calculate the time t expectations, we get a term, an expression for the expectation of the price level tomorrow. Insert this in here, and we see that we can replace, right, the price today is now not tomorrow's dividend, expected dividend, plus tomorrow's expected resale price, but it's tomorrow's expected dividend, the day after tomorrow's expected dividend, and the resale price the day after. We can do that to end periods, and we start to see, right, that the price today is equal to the sum of future expected dividends, where they're being discounted more and more heavily the further out in the future they are. I.e., it's the present discounted value of this stream of dividends, plus we have one term out at the end. This term at the end, when we take this to infinity, is what we call the price bubble. The idea is that the fundamental price of a stock, why would you own a stock? Why would you own any asset? Because it's going to pay out something. A stock is going to generate dividends. If it doesn't generate dividends, how are you going to make a profit from it? Well, because I expect to resell it, right, at a higher price. Well, who's going to buy it? Someone who expects it to go even higher. Why would they buy it even higher? Because they expect they think that someone's going to buy it for a yet higher price. If we don't have a stream of income generated by the asset, then there's nothing to justify this price being higher, other than a self-confirming expectation. So, I and my friends, we looked at Bitcoin. Bitcoin doesn't pay a dividend. How are you going to make money with Bitcoin? Well, the only way you can make money from Bitcoin is not because it's going to pay out a return, a dividend at one point in time, it's because you expect it to have a higher resale price. But that means there has to be someone who tomorrow expects it to have a yet even higher retail price. Well, this can't go on forever. So we came to the conclusion that the present value of expected future dividends is 0. This price bubble is eventually, it's inconsistent with rationality, so the price must be 0. Okay, but we can have a price bubble that persists for a while, just can't persist forever. Right, this price bubble, right, if it exists, it's going to grow over time. It has to grow here at the rate R, which gives us something that we can test. Right, you can show that right, if we have a constant dividend, in the Bitcoin's case, the constant dividend was 0. It doesn't matter, we can still solve for this price bubble has to satisfy an equation that looks like this. So the expected value tomorrow of the dividend, or this price bubble component, of the price of the security, has to be equal to the price bubble component today times 1 plus R. So tomorrow, it has to be expected to be larger than today. It has to be growing over time, right, for it to sustain. All right. Right now, ex post, the difference between the price and the present value of future dividends shows no trend. Yeah? So, well, maybe, right? You have this in the price dividend ratio. Price dividend ratio is equal to 1 dividends. This would tell us that the price dividend ratio would be growing at the rate R. Okay. How about non-constant dividends? Well, the present value fluctuates less than dividends. This is problematic, right? If the variance, right, less than dividends because if the bubble term is 0, then the stock prices must fluctuate less than dividends. But stock prices are too high; they're even higher in volatility than dividends. Right? This is something that's been shown again and again and again. Right? So maybe it's not a price bubble. Right? Maybe it's just overreactions or reactions to irrelevant information. Right? Both of these two would be indications of financial market inefficiency or lack of perfect efficiency. All right, so when we start to, it's nice to say, no arbitrage, this makes sense. No arbitrage, this means markets are making sure that prices equalize all around the world. Markets are creating a big global market that's efficient and good for everyone. But when you start to question that and see, well, is it even possible theoretically? Right? It's impossible for all of our private information to be incorporated into markets in a way that reveals our private information, simply because there are too many possibilities in the world. So there's always going to be conflation, which can lead to confusion, which is going to be imperfect. And there's evidence that weaker forms of efficiency also don't hold. So it's not clear, right? that markets are efficient. So see bubbles, for example. All right, so I'm going to take a step back. What is the whole idea behind globalization and liberalization? Where does this come from? Right, how can this maybe be linked then also to ideas of financial crisis? So, why do financial markets exist? Well, we've thought about some reasons: facilitating trade, also equating prices, right? To eliminate arbitrage. Also, banks, for example, are a good example. We have some projects in society that are going to take a while, right? I have extra money. I might like to loan that to someone, but if they're building a large new building in Ho Chi Minh City for a financial center, this might take a while, right? I can't afford to give you my money for 10 years, right? I'm going to need it probably sometime in the time in between. So we have this difficulty in societies that we have long-term projects, but the finances, the resources we're able to make available are short-term. So how do we deal with this mismatch in terms of maturities? Well, one thing that banks do is say, well, let's see, if I get 1,000 different people to give me their money, and I loan out 90% of their money, and I can loan it out to long-term projects, at any point in time, any one of these people can get their money, and they all have access to money, but I can also, because I have this collection, a law of large numbers is what's going on here, but I can take a portion of this money and provide long-term financing for long-term projects. So banks and other financial institutions exist to overcome this sort of mismatch. We also have asymmetric information, right? If someone wants to borrow money from you, what do? Right? It's the best you can do is, are they a nice person? Do I know them? Do I trust them on a personal level? This is difficult, right? If you need to build a landmark 81 tower, right? That's a huge project that costs a lot of money. You have to have lots of friends that think you're a trustworthy person if you're going to borrow money from them to build such a large building. So a financial institution, a bank, is there in terms of the usefulness is that they collect lots of people's money, and then their only job is to evaluate the creditworthiness of projects. I know nothing about building skyscrapers. I know nothing about the real estate market, let alone the real estate market for skyscrapers in Ho Chi Minh City. But if I lend my money to a bank, they might lend this money to a real estate project. The bank has information about these projects. It has experience about these projects. It might have contacts with the people involved or established relationships with them. So financial intermediaries can help deal with these information and maturity mismatches, communication transaction costs. Right, and we see a strong correlation between development of banks and financial markets and communication and information technology. Right, in terms of the global financial service, the system first started probably in the 17th century. We started to have regular postal service. We could send letters back and forth for a contract, right, or communicating, give them this money. Right, before we had financial markets, of course, we've had banks, or bank-like financial institutions in China for thousands of years, right? But on a large global scale, we had to first be able to communicate, right, in order to make this happen. 1866, we started to have telegraph cables going across oceans, right? And this pinned down where we have a lot of our financial industry, right? the cable that connected, the communication connected between Europe and North America went from London to New York. And so suddenly now, if you're going to finance projects between these two continents, if you're shipping and trading between these two, if you want good information, if you want to communicate, you want to be as close to either one of these cities as possible. And now, with telephone satellite, these communication costs are getting cheaper and cheaper all the time. I mean, it's funny to look back historically, measured in terms of US dollars today, a 3-minute call from New York to London, and even 20 years ago, that costs 30 cents. What does it cost you to talk to somebody in Frankfurt, for example, now? You do like WhatsApp or WeChat or any of these, it costs like the electricity, right? It costs almost nothing. Even 25 years ago, the only option was through the telecommunication service, and you'd have to pay about 30 cents, right? So about 10 cents a minute. If we go back to the 1990s, right, it was more than $1 per minute. And we go back to like 1930, so 100 years ago, in today's dollars, like $300. That's maybe like about $100 per minute on a telephone call. You wouldn't be talking about the newest TikTok dance you saw. That's expensive, right? Very different sort of communication. No? I don't need to tell you about the explosion of electronic interchanges and mobile phones, internet, and the like. Right? This is, of course, brought markets together. Right? We now have, because these markets are brought together, we have a competition between markets. Exchanges. Who's charging the lower fees? Who has the better platforms for conducting these transactions and trades? Better flow of information, so we have more better elimination of arbitrage opportunities, so more price equalization across markets, easier to access markets. In the deregulation, also lifting of capital controls. Right, so we see this development of globalization through time. A lot was really connected to communication that has brought the whole world together, also our financial markets. Now we think of financial crises. It sounds like this cartoon. Right, we had fat capitalism, right, lying on the beach there, right, drinking greed and having tossed its safety belt of regulations. It's just a tiny little rescue ring, and it's nothing in the face of this global financial crisis. Right, so what is a crisis? Right, a currency crisis would be a rapid, unexpected devaluation in a short period. Right, this unexpected is important if you have a currency, the change from the Deutsche Mark to the euro, all prices, so expected appreciation, but all prices in Germany were cut in half overnight. Bam. Because we went from Deutsche Mark to euro. Right? Oh, no, that's not unexpected. That was planned and, right? So it was fast, it was rapid, but it was planned and communicated. So unexpected, the unexpected component here. So if you have a country, frequently this happens in countries with a fixed exchange rate, and if you have a fixed exchange rate where, in order to support the fixed exchange rate, the central bank has to be using its reserves of foreign currency to buy back its home currency, to take it off the markets, to keep the exchange rate at its promised rate. It has only a finite amount of foreign currency reserves that it can use. And when those foreign currency reserves disappear, then we can have a very sharp drop in the exchange rate regime. Right? So this is usually easily identifiable. You have a fixed exchange rate, and then a drop. A banking crisis would be a collapse of one or more major banks or comparable institutions. Right? If we look, so since 1980, we see about 2 to 3 currency crises and 1 to 2 banking crises every year on a global scale. Right? So this is, it's interesting to take a step back. Right? If we look at global financial liberalization, right? It's not every once in a while. Right? We see essentially a banking crisis, a couple banking crises, and a couple currency crises every year. Right? Not global, not in the same country, right? But this is a regularly feature or bug in our liberalized financial markets. Right? It's no longer the present, thank goodness, the euro crisis. But we have in 1987 the U.S. SNL scandal, we had an East Asian a crisis I talked about a couple of days. We had long-term capital management. This is also a really fantastic story. Pricing derivatives. Did you learn about the Black-Scholes formula maybe in how to price derivatives?
Yeah.
Well,
Derivatives.
yeah, so derivative pricing, Black-Scholes, what they determined, they won the Nobel Prize. The way they did this, they're smarter than everyone. Why don't we set up a hedge fund and we're going to make ourselves rich, right? They made a mistake. They speculated. They didn't take into account what was happening in Russia with the bond trade they're doing. They gambled and they lost, and they were so large that their collapse caused a crisis. So Black-Scholes, Nobel Prize winners with the derivatives pricing themselves messed up so badly that they caused a financial crisis. So even the Nobel Prize doesn't protect you from being right. .com in 2000, Argentina, financial crisis in the U.S., euro crisis afterwards. Right? There's just if you look at them, right, we can start to we have. Oh yeah. So we have banking crises, currency crises, twin crises where we have both at the same time, and then just total. And so we just break the world or the time into like little chunks. Right? There seemed to be perhaps some level of stability before the First World War. In the interwar period, right, this went up, and now we had an era of stability in terms of banking crises. It then has seemed to have increased a little bit more since then. That should be the so we can think of this crisis very frequent during the Great Depression, a decline, and now crises seem to be picking up again. Right? But we have these periods of time where we had globalization in some sense, and there were a reduced amount, so it's not clear that crises and globalization necessarily go hand in hand. Certainly seems to be the case that if we have a recession by itself, or a recession with a financial crisis, that if you're in a country going through a recession and there's a financial crisis at the same time, the recession is going to be worse. It's going to be deeper, you're going to have higher GDP losses. So financial crises are bad. It's essentially this toy that you get out of you. Yeah? It's not that they're the same as any other crisis or recession. It's not that we have corona recession and financial recessions, and they have different causes, but they're the same. No, financial crises, if they cause a recession, they tend to be worse than other recessions. Right? So recessions are almost always deeper with the crisis. Right? And if you look at, so very pronounced during the Great Depression, they were just disastrous, the recessions that we had then when they came together with the financial crisis. We've seen the difference here, the difference between these two is about a 10 percentage point difference in the GDP loss. So if you would have a GDP loss of about 7% during a standard recession, if it's accompanied with a financial crisis, that's 17%. Right? That's a huge number. So it's not just a little bit worse. It seems to be a lot worse. Okay, so the recession is deeper than the financial crisis. It's also longer. It takes you longer to recover from a recession if it was accompanied with a financial crisis. And so a recession that's caused by or associated with a financial recession is deeper, more pain, and for longer. So crises lengthen and deepen recessions. Okay, capital controls and frequency of financial crises. So the idea here, if we look, if we control the movement of capital, import and export of capital, so if we don't let people or foreign investors in, right, as easily, or right, if we don't let foreign investors flee our country with their investments, right, if we regulate the movement of capital, right, this might help reduce the frequency of financial crises. And it seems like there's some evidence historically. Before the Second World War, we had crises without capital controls, so more frequent than crises with capital controls. Right? But since then, that's changed. Now, the difficulty here, but think of the causality. Remember my umbrella in the rain. So is it now, am I trying to say that capital controls are causing financial crises? So that by restricting the movement of capital in and out of your country, you're going to make a financial crisis more likely? Or could it be that when you have a financial crisis, because we've learned it's useful, a policy response is typically to then restrict the movement of capital? Oh, that's different. That's a completely, right? Is the capital control causing the crisis, or is the fact that we have a crisis making policymakers decide to implement capital controls? Right? So, some people can look at it, and also another way to look at it with counteracting. Right, if we still take the causality route, yeah. So here, if we take the causality route, so we have capital controls causing financial crises. The idea is that without financial market discipline, right? So if we have free capital movements, then the financial markets will punish us if we behave badly. Right? If we have capital controls, however, currency crises tend to occur more frequently. Right? Knowing that foreign investors aren't going to be able to move their capital in and out of the country as easily, governments can get away with pursuing riskier policies. Right? And they're less credible in their willingness to defend a currency crisis, because if the currency collapses, no big deal. It's not like the foreign investors are going to leave our country with their capital because they can't. We're going to keep it in here, they're stuck. So it's not such a big deal if we have a currency crash. Right, but without access to the international financial market, banking crises occur less frequently. Right? Banks are less likely to engage in riskier financing because they're not able to move capital in and out. So, if I'm a bank, I don't know, I'm going to finance a project in Malawi. I don't know. It doesn't matter, because if something starts to go wrong, I'll just pull my money out. So I don't have to pay attention. I can just engage in risky financing. But if, it's kind of hard to move your money in and out of that country. Like, okay, let's really make sure what we're doing is the right thing. Right? It gives financial markets an incentive to engage in more due diligence. Here the argument is if it's causal, then we have the currency effect is dominating this banking effect. Current account and cost of financial crises. So if you're running a current account deficit, So if you're a net importer, are more countries that experience crises net importers and net exporters. Yeah? And we see that those who are net importers or net exporters historically are more likely to have a crisis, and now we see with the current account deficit, so net importing countries tend to be, or tend to have, I'm sorry, it's not the frequency, it's the magnitude of the losses, right? So that's what it is, yeah. Now we have countries who have a current account surplus tend to not suffer from a financial crisis as strongly as those who have a current account deficit. I think the idea being that if you have a current account deficit, you're dependent on the international financial markets to fund the goods, domestic demand, right? And if you have a sudden stop of capital inflow, this is going to cause a very sharp decline in things like consumption and investment because you have a large net import. Your economy is dependent on import. So think of and before 1973, we had more like the gold standard, the Bretton Woods policy, and the finance. The current account was more finance private to private. It was less this country-based system that we have now. So you definitely see, the change in gold standard periods, Bretton Woods, and today. Okay. Liquidity supply to banks. So without, you get a larger loss of GDP during a financial crisis if you supply liquidity to banks. So this kind of makes sense. If you're in a desperate situation, on the one hand, you want to maybe as a government step in and help the bank out so that it doesn't get any worse. The problem is if a bank, if I'm already in a tough time, so imagine I'm in debt. I'm in debt to the mob, to the mafia. I owe them $1 million. I need to give it to them tomorrow. I don't have any money, and you give me $100. Well, I can't. That's not going to help me. But no, I can take these $100 you gave me, and I'll go to the casino. Right? I'll go to Macau and see if I'll gamble this, and maybe if I get lucky, then I'll get the $1 million, and I can pay the mob, and I'll be okay. So this means the $100 you gave me, it's not going to help me. It's not going to help the crisis. It's not going to help the problem. I'm just going to gamble this to see if I can dig myself out of this hole. It's a behavior called gambling for resurrection. You're insolvent, you're broke, you're in big trouble, but you're going to do something extremely risky just in the hopes that this will save you. Of course, this rarely works, and the costs are high, your $100 are gone. It's interesting that before 1913 was less of a problem. Right? Maybe we had a better job in determining which banks were illiquid only, and we supported them. But insolvent banks that we did not support, this has now been a huge problem. Talk about like moral hazard and the like in the financial crisis. It seems to be costs are much higher if we supply liquidity to the banks. Right, so financial crises are a common occurrence in history and today. This is not like we saw the financial crisis, the Asian crisis 30 years ago, and we're going to be fine. Every year we have a couple of banking crises. Right, just a couple of years ago we had a banking crisis in the United States, the Silicon Valley. What's the other one? I forgot the name. And Switzerland, one of the two largest Credit Suisse, went bankrupt. Right, it was on the verge. So even, and it's not limited just to every country in the world is at risk, I guess is what I'm saying. Right, so it's important to understand the historical context, right? We can see maybe some effects, there's some change over time. Right? Capital controls and liquidity supply can help make this better or worse. Not overtime, 3 minutes. No one's gonna miss the bus. Thank you all very much, and I'll see you tomorrow. And the one thing that's important, so tomorrow, we're gonna do a half day, and then yeah. So nice and easy then tomorrow.